Welcome to Investors Guide, and thank you so much for tuning in. I first want to thank you for the phenomenal response we received on the show we gave you last week, which is the top mutual funds to invest in 2015. We've attempted to respond to each and every one of your emails, but if you like that list and you haven't received it, please send us an email or reach out to me on Twitter, and we'll make sure we get that list to you. On the show this week, we'll help a 24-year-old young investor with a very impressive portfolio check and see if everything is on track. In our product review, we look at the Reliance Tax Saver Fund, and we're taking a very close look at gold. How much lower can the prices get? Does it make sense to invest right now? All of that coming up later on the show. All right, speaking of the top mutual funds to invest in, let me bring in Kumar. Is the one who designed that beautiful list for us. Thank you so much for coming into the show. We've received a fantastic response for last week's show, so we have a lot of viewers who are really looking forward to what's going on this week. And just as well, because we have a fantastic portfolio to look at. Pranav Mehta has written in, he's only 24 years old. He manages to save 45,000 rupees every month out of his salary. He has health insurance, he has life insurance, he has 1 lakh rupees set aside in fixed deposit for emergencies. So he's checking all of those boxes. Let's look at his investments. 2.5 lakhs in PPF, 4.5 lakh rupees in a savings bank account, and he invests about 12,000 rupees in mutual funds. Now, his goal is to put aside 7 lakh rupees for emergencies. Now, I'm not really sure why he needs that much in emergencies. He wants to buy a luxury car in the next 10 years, and he wants to plan for all of the big things that will happen in the future in terms of retirement, in terms of children and weddings and all of those things. My first reaction is to just congratulate a 24-year-old for being so careful and so meticulous when it comes to his money. What's your reaction to his portfolio?
No, I'm greatly impressed. Not more than, all the things that he has done. He's so focused on savings. And that is something which at this age gets difficult, because you just have, this is a stage when you have less savings and you're very focused on spending rather than savings.
Well, Dhirendra, before we get into the list of mutual funds he's invested in, he wants to know if there's an alternative for his PPF investment. He also wants to know how he can go about buying that luxury car. So let's look at the PPF investment right now. For someone that young, to be putting 2.5 lakh rupees every year in PPF and a smaller amount, marginally smaller amount in equity, would you like him to rebalance that a little bit and move more money into his mutual funds?
He's investing about, 12,000 rupees a month in these 4 mutual funds. And I think, the allocation to your PPF investment, which can be a maximum of 1.5 lakh rupees per annum, I think it's not a wise thing, because a long-term fixed income investment, even though the perception, the opinion about PPF is primarily driven by the fact that all your gains from all your income from PPF is tax-free, and it is very safe. But I think it's a huge missed opportunity on a long-term savings, because equity will definitely produce far superior return on a 15-year term. That apart, if you hold equity for 1 year and more, that also becomes tax-free.
All right, let's take a look at his mutual fund investments, Dhirendra. It seems like he's really impressed with iPru, because 3 out of 4 of his funds are from that fund house. He might be a little, overexposed to one fund house. iPru Dynamic, iPru Focus Blue Chip, iPru Value Discovery, those are the 3 funds, and Reliance Equity Opportunities is the 4th on his list. Now, they're all good funds, but would you like him to, sort of rationalize that choice a little more?
Yeah, absolutely. That is a risk which he should insulate himself from. And that itself is a risk, and if I look at, Dynamic and Discovery, it has similar tilt. So I would say he should consider our aggressive growth portfolio. That will ensure diversity across style as well.
Our aggressive portfolio is on your screen right now. It suits you perfectly given your age and your time horizon, and of course the fact that you have everything else so clearly sorted out. We wish you good luck for the future, and of course we're going to be here to help you and hold your hand with anything you might need. Another question comes in from Karthik. He tells us he has 2 home loans, Dhirendra, and 1 car loan, and he knows he's going to get a bonus of 5 lakh rupees at the end of this month. He has mutual funds he's been investing in based on the advice of this show, and he's very happy with the returns. He says he has a compounded annual rate of return of 20%, and he has 10.5% on his home loans. What should he do with his 5 lakh rupee bonus? Should he pay off a portion of his home loan, or should he be investing it in his mutual funds that are giving him such fantastic returns right now? What would you recommend?
don't prepay. I would say that, given your experience that you have been able to derive superior return from equity. And even if you don't get the kind of return that you have been able to derive so far, if you are able to get more than what the cost that you are incurring on your borrowing, and that too, it is not a short-term borrowing. Home loans are long-term borrowing. So from that standpoint, I think it will be wise to carry on with your loan and make this investment. Yeah, and the bonus that you are getting, maybe spread it over the next 12 months. That way you will be able to average. That part, the whole idea is that you should not be out of the market with your long-term money for too long. So from that standpoint, don't stretch it, for many, many years.
Welcome back. You're watching Investors Guide and ET Now. Thank you for staying with us. This week, the product review we're looking at is the Reliance Tax Saver. Avan will give us a quick introduction. Avan.
Thanks, Faye. Now, if you've begun the new year with a desperate search for tax-saving mutual funds, then you don't have to look any further. With over 3,700 crore rupees as assets under management, the Reliance Tax Saver is proven to be quite the blockbuster performer. The fund does have a patchy track record. It lagged behind its benchmark in its early years until 2010, but managed to really turn its story around last year, proving that while returns are great, this fund is not for the faint-hearted. The fund's choppy performance is thanks to its mid and small cap tilt, which is also the reason for its stellar returns. One factor which has contributed to a stable strategy and a good 5-year record is the stable fund management team for the past 9 years since its inception. Returns, however, tend to be quite volatile and hinged on the ups and downs of the mid and the small cap universe. The Reliance Tax Saver is a fund for aggressive investors in the ELSS category. With that, it's back to you, Faye.
All right, Avan, thank you for all of that information. The Reliance Tax Saver, from the last time we talked about it, has gone up 2 stars on value research. How would you, rate this particular fund, and are you impressed with the, the movement it's shown us in the last 1 year?
Yes, last 1 year has been, very impressive for this fund, but so has been for many other funds, and understandably so. Even in our last review, we were impressed with the portfolio, but it has only been till that point. It was only the kind of portfolio it has is destined to struggle in any market phase of that kind. So I would say that this fund has been proved to be a blockbuster, and in any good market it will remain so, given its orientation. 60-65% into mid and small cap stocks, very selective. Quite a distinct portfolio, so and that has worked. And I think for a fund like this, as I keep saying, that most investors take a compromise on the liquidity. You get stuck with a tax saving fund for at least 3 years. But anyway, investors should be looking at a period of not just 3 years, but even much longer with any equity investment. And this kind of orientation, given the 3-year lock-in, the fund manager has a premise to assume maybe a reasonable liquidity risk with his underlying investments, and that has worked in very nicely. In a full market cycle, a fund like this will always do well.
All right, Dhirendra, I'm going to ask you to rate the Reliance Tax Saver for Investors Guide, keeping in mind the viewers who are watching. What rating would you give it?
For any investor seeking aggressive return, this looks like a finest choice today, and I would assign it a 5-star.
All right, 5 stars there for the Reliance Tax Saver Fund. Remember, 5 stars is really hard to get on this show. So if it's getting 5 stars, it means that it is a good fund. But remember, it's aggressive. So only if you have the stomach for that sort of aggressive investment should you consider a fund like this. Otherwise, there are conservative tax savers that we've picked for the year. That's on your screen as well. That's the alternative if you're looking to save tax this year. One very quick question before we wrap up. Nikita has written in, Dhirendra. She writes on behalf of her mother, who's 60 years old and lives in Thane. She says her mother's made investments in fixed deposits and they'll mature this month. She wants to know where she can invest the money to get better returns than a fixed deposit, as well as a regular income. She has about 50,000 rupees as well in the PPF each year, and she wants to know if she should continue that investment. Now, for someone who's already retired, does it make sense to invest in the PPF, Dhirendra?
No, it doesn't make sense, because it's a very long-term investment. At the same time, it's important for a small part of your money which will be locked in, and you plan to derive the tax benefit on such investment. I don't think that makes sense. at least, you have no equity, for a person who has no equity exposure, at least that 50,000 rupees should get into an ELSS fund so that it is a hedge against the inflation, which will be eroding your capital, which is invested in fixed deposit. Coming to the point of, superior options to fixed deposit to derive income on which you depend on, you don't have too many reliable options. And the bad news is that in coming times, the interest rates will come down and you will have your income from those deposits will be even lower. So I would say renew as much, a part of your fixed deposit, which you are unlikely to, on which you will definitely depend for deriving the income on which you on a monthly basis. That much money must get into fixed deposit, and quickly, because you will be able to roll over your deposits at prevailing higher rates. These high rates may not prevail for a long time. You also consider, the senior citizen plan, deposits offered by most banks, which yield marginally higher return than the normal fixed deposits offered to consumers. And rest of the money, consider, ways to participate in equity, invest in equity even in a conservative way. So that you are able to replenish you are able to protect the worth of your capital over time.
All right, so our conservative portfolio is on your screen right now. That's something you might consider, because you will, at the age of 60, need to beat inflation over the years to come. Dhirendra Singh PPF, which is meant for someone who's going to retire. So if you're a young person who's going to retire, that's what the PPF is designed for. It doesn't suit someone who's already retired. So the senior citizen savings scheme or fixed deposit, and of course our conservative portfolio. If you have questions for Dhirendra or for me about that, feel free to write to us. Our email ID is at the bottom of your screen. Dhirendra, thank you so much for spending time with us this week and answering all of our questions. We look forward to spending time with you again next week. Welcome back. You're watching Investors Guide in ET Now. Thank you for joining us. Like I promised, Naveen Mathur from Angel Broking is back in our studio. We're going to talk about gold. Now, Naveen is the Associate Director, Commodities and Currencies at Angel Broking, but you've been on the show so many times before, and we've had viewers who've written in saying, when is Naveen coming back? So we decided we must bring you in with the new year. So Happy New Year, Naveen. Thank you for coming in. We've had a lot of questions, obviously, from investors of both gold ETF and physical gold, who've been asking us what's going on with the commodity, because this is, I think, the longest stretch we've seen in recent history where gold has not performed. And even in the mutual fund universe, any mutual fund I invested in, any at all, over the last 3-4 years has done well. And right now, bottom of the leaderboard is gold ETFs. So I want both your short-term and your long-term view on gold.
Thank you very much, Faiz. And definitely would like to give the best wishes on the new year to you and the entire ET Now viewers. The point is, what you're talking about is absolutely correct. The gold prices have corrected in the last 2 years, that is 2013 and 2014 calendar year, and doesn't look like to have a positive return even for this year. 2013 was around 30% decline we saw in the gold prices, and 2014, although we didn't saw much of a decline, it was 2% decline in international markets. But I think it was more or less stable for 2014. Coming back to 2015 and the outlook for 2015, I think the reasons why the markets are behaving this way for gold are very simple, and all of us know today. The US economy is improving, one. The dollar index have gained strength because of the US economy recovery. We don't have too much of geopolitical tensions. We do have Ukraine and Russia conflict going on, but that reaction on the gold prices is not there. We also see the scenario in terms of the ETF buying or selling. We have seen the ETFs selling over a period of time. The gold ETFs world over has sold their stocks or sold their holdings. So I think all these particular fundamental factors relate to the declining trend continuing for 2015. And even the hedge against inflation demand is not there because the crude prices are down. The world over inflationary expectations are very, very low. Actually, most of the countries, let me say about the Eurozone, China, Japan, and particularly emerging markets, the inflation is pretty much on the downside. We don't have high inflationary expectations. In fact, the Eurozone is thinking, or they are they're talking about deflationary concerns in coming time. So I think on safe haven, on the hedge against inflation demand, the gold is not doing too great.
So tell me this, okay, we are now in the 26,000 per thola range broadly. Do you expect it to go lower when you say the bad trend is going to continue in 2015? How much lower are you expecting it to go?
India, we know, is a market for gold. Although we have lost the largest consumer tag some 2 years back to China. But I think with the lower prices at around 25, 25 and a half, which is currently, as of now, 27,000 or so for 10 grams, I think the prices may go into an extent of 25 to 25 and a half. There onwards, the probability of going down further would be pretty less. Because if the dollar will gain strength at the same time, the rupee would also therefore weaken and may hold the prices on the downside. So I think with the demand may coming up at around these levels of 25, 24 and a half, the prices may consolidate at these levels. It may not go down further. But the long-term perspective looks like that around 27.5 to 28,000 we can see the prices come back. But I'm not saying about tomorrow. I'm saying about, say, another 3-4 years time frame. That at 25,000 for a long-term investor, that would be the right place or the levels to accumulate or buy gold for a long-term perspective for around, say, 3-4 years to look forward to around 29,000.
All right. So quickly, to put it in a nutshell for our viewers, you're saying from where we are right now on the price of gold, domestic price might come down to 25 or 25,000 and a half.
Absolutely.
Which would be a good time to buy.
Absolutely.
And from there, over the next 4 years, we expect it to climb back up to
28 to 29,000
28 to 29. So technically, from this level where we are right now, there isn't too much of a profit to be made for the next 5 years at least.
Doesn't look like to be as of now where we stand today.
Okay. So a lot of times, let me put this very clearly, a lot of times the viewers who write into us talking about investing in gold are doing it because there is a wedding that's going to come up, or there's a little daughter who's been married and want to put money away. Now, would I be better off, and I want to ask you a slightly tricky question, would I be better off at this point putting some money in equity through an SIP, mutual fund, over the next 3-4 years, taking it out then and then buying gold, or taking it out at that low point that you say 25, 25 and a half and then buying gold? Does that make more sense?
You were not the first person who asked me this particular question. I keep meeting people and they keep pouring these kind of questions to me. I would recommend that, and it's been recommended all over, that 10 to 15% of your portfolio should be dedicated to gold at all the times. Be there in equity markets, don't get out of the equity markets. Place your money a little bit on the debt because interest rate's going to come down. And as I said, part of that particular 10%, 15% of the portfolio, keep it invested rather than looking forward for any kind of returns or levels. Don't look out for building up the portfolio on a certain price. Be a staggered investor. Build that portfolio to an extent of 10%. After that, if you feel that you want to trade on, you want to make some money, maybe then you can time the market, think about whether 25,000 or 26,000 would be a right level.
Kevin has written in, he wants to buy gold for his daughter's wedding with a time horizon of 25 years. And he wants to know which gold ETF he should invest in today. So, I mean, this is another interesting question because the gold ETFs largely have the same underlying asset. So they're very similar to each other, difficult to pick from. How should an investor pick a gold ETF?
No, it's easy to pick them up. One of the best of the characteristics of the ETF is the underlying remains gold. So all that price trends of the physical gold are underlying gold as an asset, somehow being paralleled onto the prices or the NAVs of the ETFs. Now, there are 14 ETFs in India which are currently running by different asset management companies. I think the best one is the Gold Bees. Why I'm saying this is because one of the major factors which you need to look into before venturing out and going and buying in the ETFs and trade on the ETFs is the liquidity aspect. So I think that is one of the best ETF because of the liquidity, because of the AUM which they manage. The underlying remains the same for all the ETFs. So if the liquidity is high, it is easy to get into an entry, and when you want to move out, hence, it becomes pretty much easy at the time of exit too.
Putting money aside every year in a gold ETF, is that a good way to go?
Absolutely, absolutely. I think he's doing the right job. He's preparing himself for this 15 years time frame which he has put in. So I think my recommendation would be it's the best mode to go into. But all said and done, that's the most easiest way to do it. They trade on the NSE, they trade on the BSE. So just buy and sell. Don't worry about any storage stuff.
Personally, I hope that by the time Kevin's daughter is ready to get married, this business of having to have a lot of gold because you have a daughter is completely written out, in which case gold ETF is a good idea.
I mean, we as humans in India, I don't think so that I'm going to go out. Yes, I am also doing the same way for my daughters, investing in gold ETF every month. So I think being Indians, we think that the gold is paramount for any kind of a marriage. Whether it will happen or not is something different. I also feel after 15 years, maybe people will look forward for platinum and all other things. But still, all said and done, gold still will be one of the most precious assets for Indians, and I think continue to be.
From my point of view, if Kevin's daughter decides to go overseas and do a really fancy course, the gold ETF can still be used for that as well.
It'll be an asset where Kevin can utilize it for any kind of an adversity.
Any
so
kind
I
of
think, let it be marriage or not, it's a store of value. So I think.
Let's take another question. Mahendra has written in. He says, now that the prices of gold are low, is it a good time to invest in the SBI Gold Fund? He wants to know how many years should he hold this fund for?
As I said, I'm not saying that SBI fund is good or bad, but what I'm trying to say is if you have started off and you want to start off, go into for this particular Goldman Sachs gold ETF.
For those of our viewers who don't understand, there's a gold ETF for which you have to have a demat account to buy into. And if you don't have a demat account, there's something called a gold fund, which you invest in, that you'll invest in an ETF. So there's a certain amount of efficiency that's lost out.
The only difference is that in an ETF, the underlying remains the gold and gold only as physical gold or the gold as a commodity. In gold funds, it is gold along with the companies who are either related to gold mining or something. The second part is because it's a fund of a fund, the gold fund per se, so the costs or the expense ratios would be higher than the ETF because it is one step ahead in the hierarchy of expenses. It is a fund of a fund. So it means one cost is definitely of a fund, and then a fund of a fund definitely would have an extra additional expense cost. So it would be little costlier in terms of going in for a gold fund rather than gold ETF and versus just the gold. So it plays out like gold, the gold ETF in terms of cost, and gold fund of fund, which is a gold fund. So I think it is a costly proposition. It's better to go in for ETF rather than going in for the gold fund.
So make sure you get a demat account. And of course, if you have questions for Naveen, write to us. Our email ID is at the bottom of your screen. Naveen, you'll come back next week to answer questions, won't you?
Thank you very much. I will be.
All right, send in questions that you have for Naveen to the email ID on your screen. You can write to us about anything at all to do with your money, gold and any other kind of investment. And tune in next week to catch Investor's Guide. Thanks for watching.